Students, today we are going to see the course is indirect tax. From the topic which we are going to cover is canon of taxation. Now we see the meaning of canon of taxation. The canon of taxations are subject state out to contribute towards the support of the government as nearly as possible in proportion to their respective abilities, which is given by Adam Smith in the year 1776. In 2 months, the 2017 General Assembly will be held in Prague. The theme for this year meeting will be advances of the tax administration towards greater taxpayer equity by improving effectiveness and efficiency. While taxation has been around for a good number of centuries, the canon of taxation were first presented by Adam Smith in his famous book, The Wealth of Nations. These canon of taxation define numerous rules and principles upon which the taxation system should be built. Although these canon of taxations were a good while back, they are still used as the foundation, well discussed in the principles of taxation. The meaning of canon of taxation is an administrative aspect of a tax. They relate to the rate, amount, method of levy and collection of a tax. In other words, the characteristics or quality which a good tax should possess or described as canon of taxation must be noted that canon refers to the quality of isolated tax and not to the tax system as a whole. A good tax system should have a proper combination of all kinds of taxes having different canons. By canon of taxation, we simply mean the characteristics or qualities which good tax system should be possessed of. Adam Smith canon of taxation we'll see briefly. First one, canon of equality. Every fiscal economist along with Adam Smith stressed that taxation must ensure justice. The canon of equality or equity implies that the burden of taxation must be distributed equally or equality in relation to the ability of the taxpayer. Next we will see the canon of certainty. It must have an element of certainty. According to Adam Smith, the tax which each individual is bound to pay out to certain and not arbitrary. The time of payment, the amount to be paid out to be clear and plain to the contribution and the other person. Next we will see the canon of economy. The principle suggests that the cost of collecting a tax should not be exorbitant but be the minimum. Every tax has to be contrived as both to take and keep out of the pocket of the people as little as possible over and above what it brings into the public treasure of the state. Next we will see the canon of convenience. According to this canon, the tax should be collected in convenient manner from the taxpayer. Adam Smith stressed every tax ought to be levied at the time or in the manner in which it is more likely to be convenient for the contributor to pay it. For example, it is convenient to pay a tax when it is deducted at source from the salaried classes at the time of paying salary. Next we see the canon of elasticity. Taxes should be elastic in nature. That means automatically fetched when income of the people rises. This means the taxation must have built-in flexibility. Next we will see the addition of canon of taxation. First one, canon of productivity. This implies that the tax must yield sufficient revenue and not adversely affect production in the economy. Next, we'll see canon of simplicity. This norm suggests that tax rate and the tax system ought to be simple and comprehensively and not to be complex and beyond the understanding of the layman. Next we'll see the canon of diversity. Canon of diversity implies that there should be multiple tax system of diverse nature rather than having a single tax system. From the above discussion, it is followed that the purpose of generating revenue, that is taxation, is to raise revenue for the government, to redistribute income and wealth from the rich to the poor people, to protect domestic industries from foreign competition, to promote social welfare. Now we'll see the assessment year and the previous year. Defined under section 2, it means a period of 12 months commencing on 1st April every year. In the previous year, it means the financial year immediately preceding the assessment year, it always ended 31st March every year. In the assessment year, it must mostly a duration of 12 months. In the previous year, it has a duration of less than 12 months or every more 12 months on the case. Thank you.